Hello everyone. I am Dr. Dolly Roy Chaudhary and I am from SMS Lucknow, that is School of Management Sciences, Lucknow. And today I am taking up this session on ratio analysis, and I hope that this session is able to not only make you accustomed with all the regular formulas of ratio analysis, but also help you in gaining a detailed, meaning on the aspects of various formulas and what kind of interpretation each and every formula gives you. So, keeping this in mind, it is very important that before moving on to what ratio analysis is, we should actually first understand the meaning of the term ratio. So, if we go in mathematical terms, then ratio is usually the expression of one number to another or the relationship between two numbers. But when we talk about it from a financial point of view, or banks are talking about ratio analysis, then mostly what we are talking about is the financial elements which are present on our balance sheet, and a relationship is sought between their amounts, and a logical inference is drawn from that to tell us that whether the how the concern is performing and whether it is meeting out the expectations of the owners, the investors, and the various stakeholders that are involved in the company. So ratio analysis is basically an expression of one item on the balance sheet in expression to the other item. All right. To understand it in a better way, I would like to give you an example, after which it will be crystal clear to you as to what is the relevance of ratio analysis and why it is one of the most sought after tools for financial statement analysis in today's time. Like, if I tell you, suppose there are two companies, company X and company Y, and I tell you that the sales amounts of both, that A is selling around 1 lakh worth of goods and B is selling 5 lakh rupees worth goods. So now comes the question that I would like to ask you this question, or in a very general layman terms, that which company would you choose to invest? Which company is performing better? So what will be your answer? Your answer, most of the students I have discussed this in class. So the response which I have got is that obviously we will go with company B because it is making 5 lakh rupees of sales. So I'm like, okay, fine. You are going to choose company B. So now I am adding another information. Another information is like I am telling you the profits of both the companies. Company A is making 10,000 profit and company B is also making 10,000 profit. Now, um, immediately you will, be questioning your choice, that you chose the company B, and while company A is also making 10,000 profit, B is also making 10,000 profit. So, how do you understand which is more profitable? Here comes the play of profit margin. Immediately you will analyze. So, in the first scenario, the profit margin where the sale is 1 lakh rupees and the profit is 10,000 rupees, so immediately you will see 10%, while on the other company B, the profit is only 10,000 and the sales is 5 lakh, so you will see that there is only a margin of 2%. So most of my students at this stage, they change their answers and they're like, ma'am, we will like to choose the company A because yes, the profit margin is more in company A. So, see how your response changed, how your reaction changed, just by telling you one more element in the whole picture of balance sheet. With the sales amount, you were contented to go with company B, but once you are getting to know the profit and the profit margin, immediately you changed your answer and you are back to like, no, no, ma'am, we want to go with company A because the profit margin of 10% is higher than the profit margin of 2% which is given out by the company B. So this is one very important thing I wanted to discuss with you. And apart from that, I would also like to discuss that what are the basic objectives of ratio analysis. See, there are different types of ratios which are given to you. Usually, the profitability ratio, the turnover ratios, the solvency ratios, the liquidity ratios. So, one by one, if you see the profitability ratio, what it tries to do, it helps you in finding out that what is the amount of profit or what percentage of net profit, gross profit, operating profit you are making, and whether you can even compare the trends that last year the ratio was this much, this year it is this much, the next year it is this much. So are we like in an increasing trend, or are there, is it possible that last year we made more profit, the ratio was higher last year, and this year it is comparatively less? So what efforts we need to make this year so that again we can achieve our increasing trend of profitability, we can achieve that. So I'll say that one of the objectives of ratio analysis, and as far as we can say the profitability ratios, is to find out how much profit we are making, and is that profit the amount of the targets that we have set, are we able to meet it or not. Then comes the turnover ratios, the solvency ratios. They help you in finding out the productivity of the assets which are there, and whether the assets are being fully utilized to generate revenues or not. Apart from that, the liquidity needs. Liquidity is basically, like whether the firm or the company is able to honor its short term liabilities, and whether it is able to meet them, the short term expenses which arise as and when. So for this, there are current ratio, there are quick ratios, then liquid asset, absolutely liquid assets are available, and the ratios you have to find out, like the quick ratio, the current ratio. So these are some beneficial tools available with us to measure the liquidity of the firm. And the ideal ratios are also given, like suppose current assets and current liability ratio should be like 2 is to 1, which means for every one current liability there are two current assets to cover that liability. So it is supposed to be the ideal ratio. Apart from that, it also helps in finding out the financial status of the company, and it enables, like I told you before, the comparative analysis is also helpful. Now obviously, this chapter is more quantitative in nature, and various formulas are there which need to be discussed. But apart from that, what is really important apart from the formula is that you have to know the understanding, that is what is the interpretation behind it, behind every formula. All right, so I'm just going to share with you in a snapshot the types and classification of ratios. Yes, this is the enumeration, and you need to know the formulas of each and every one, and also their interpretation. So let me start one by one. One by one, I'll start with the gross profit ratio. The gross profit ratio, what does it mean? It just shows you that if the ratio is high, suppose there is a high gross profit ratio, it indicates that the concern is able to generate high margins on the product sold. All right, high margin is being generated. It can also be used for comparing the performance of multiple firms. The firm should maintain proper profitability ratios to keep its financial position and demand stable. Net profit ratio. Next comes the net profit ratio. It measures the overall profitability of the business, and a temporal analysis may be done to see the trend of profitability. The ratio should be used in connection with those other ratios to get the overall picture of the business concern. So, this is another important thing that you must know. Operating ratio. See, operating expenses are basically which are charged against the earnings, which include the administrative expenses and the selling and distributive expenses. Like the administrative expenses would be like salary, tax, rent, legal charges, and the distribution expenses will be like packing, warehousing, discount received, and commission on sales. So that has to be kept in mind. The ratio shows the cost structure of a firm. Higher operating ratio indicates that the firm has less margin for meeting its non-operating expenses and thus is an unhealthy condition of the firm. Efficient firms usually show low operating ratios. All right, so these are some ratios which we can discuss. Apart from that comes the return on capital employed, then return on investment, market price per share, earning per share. These have to be kept in mind. And then comes the turnover ratios. So basically activity ratios, they indicate the performance of an organization. Various assets are employed to generate revenue and profit, and these assets need to be managed efficiently. What about the fixed assets turnover ratio? As far as the formula goes, it is net sales upon net fixed assets, and this ratio is used for making interfirm comparison. A low ratio shows that either the firm has made high investment in fixed assets or that it is unable to utilize the assets in efficient manner. So high fixed asset ratio shows that the company is efficient, but it may be operating at overcapacity. Similarly, stock turnover, debtor turnover ratios are given to us, creditor turnover ratios, and they are basically showing that the analysis of the liquidity ratio, the current asset ratio, and the quick asset, the asset test ratio, it is also known as, are given to you. And I will also be sharing the formulas with you. Analysis of the solvency, debt equity ratio, proprietary ratio. So these have to be kept in mind when you are solving the questions. Alright, I would now like to take a minute and share with you the summary of the ratios, the formulas, current ratio, the quick acid test ratio, then the debt equity ratio. These are the formulas which I am sharing with you. They are very important from the examination point of view. Net profit ratios, activity ratios, or the turnover ratios. So I hope that whatever I shared with you was helpful to you in your preparation for the examinations in some way or the other, and the snapshots of the formulae and the you know the number of ratios that we have, whether they are your solvency ratios, your liquidity ratios, or your turnover ratios, profitability ratios. They are helpful to you in solving the questions for your examination. But children, just remember that this topic has been introduced to you very early, and but it's its reach is way beyond. Like I'll share my personal experience with you. When I was doing my PhD, so many of my peers were using ratio analysis techniques to compare various huge companies that we have, because as you know that the companies publish their annual reports, and their balance sheet forms a part of their annual report. So it is basically a available public document. So if somebody is comparing the companies in the nifty 50, or any listed on any stock exchange, or they want to compare any two companies and they have the balance sheets, then it's very easy. You just compare the ratios that have been given to you, or just you pull out the numbers from the balance sheet and compare them. So you can actually give your opinion based on these ratios, and such small and easy formula you can actually find out whether the company A is more profitable or company B is more profitable, or which one is more solvent, which one is more liquid, which is the activity ratios which I just discussed with you, who help you in finding out whether the fixed assets are being utilized properly and fully or not. And such opinions you can give based on just uh, you know finding out the ratio analysis. I know that whenever students of finance, they hear the term financial statement analysis, so it kind of strikes a very wrong chord with them, and they are like totally perplexed. Now what we have to do, we have to compare the balance sheets of two concerns. How do we go about it? There are so many amounts and so many information given to us. So I can say this to you, and even I have written a couple of research papers with the help of ratio analysis, that it is one of the easiest tools which are available with us finance people to compare two balance sheets. And yes, we can express our opinion based on that, based on these four types of ratios that you have. And at this level, you just have to learn the formulas, or you don't even have to learn, just a couple of numericals you will solve, you will get the formula. It is very easy. What is current ratio? It is current assets upon current liabilities. So if you are in a position to identify in the balance sheet that, you have to separate that, which are the current assets, which are the current liabilities, which are the fixed assets and the long term liabilities. If you are able to differentiate that at this point, so for now, that is enough for you in solving your question. And you can just give out your interpretation, because see, in ratio analysis, what is important is drawing a meaningful conclusion. Like, ऐसा नहीं है कि सिर्फ प्रॉफिट एंड सेल्स यू आर कंपेयरिंग एंड टेलिंग मी कि प्रॉफिट मार्जिन ऑफ A is 10% and profit margin of B is 2%. So that is not enough. You have to interpret it that obviously we will choose to invest in company A because the profit margin is 10%, which is higher than the one which is expressed by the company B. And how you have reached that conclusion, that is also very important, because in examination you have marks for steps. Step marking is there. So how do you arrive to your final conclusion? Those steps also have to be included when you are doing the study. All right, I hope that I have been able to provide you some sort of insight on this topic, and it has been of some help to you. So ratio analysis we have done, and a week back we did cash flow statements. After that, I've been continuously coming up with various topics, and I hope that I've got a lot of love and appreciation from you all. So I also take this opportunity to thank you all, and a special hi to all the new subscribers. And I hope that this session will be as enlightening as the previous ones were. And the next one which I am going to come up with is the fund flow statement, and also few topics of entrepreneurship. I have received some requests from my students to take up a couple of topics from entrepreneurship, so that is also going to follow eventually. Okay guys, bye bye.